Today's market prices unmistakably reflect the powerful forces currently shaping our world. There are 3, sometimes even 5 major drivers that influence these dynamics, and any changes to them inevitably ripple through market prices. The first major driver is the relationship between money and credit. When individuals or governments spend far more than they earn, large amounts of money are printed and injected into the economy. This flow of new money ultimately shows up in market valuations, and that is exactly what we're witnessing now. The second key force is the deepening internal conflicts within countries, driven by widening wealth and political divides. These rifts fuel tensions between the political left and right, affecting policies on taxation and capital flows, all of which shape markets. As these divisions shift, so too will their impact on prices. The third big influence is the rise of a new global power, China, challenging the existing world order. This geopolitical competition is already reflected in markets and will increasingly affect them as events unfold. Beyond these 3, 2 other historical drivers must not be overlooked. Technological innovation and adaptability, which are advancing faster than ever, reshaping economies and daily life. Ignoring these shifts would be a mistake. Acts of nature such as climate-related disasters and pandemics, which history shows have ended more lives and collapsed more civilizations than even wars. The recent pandemic is a stark reminder of how quickly these forces can disrupt societies and markets. All of these drivers remain central to the ongoing evolution of market prices. Looking deeper into today's dynamics, both individuals and nations are overspending relative to earnings, creating a heavy need for money exacerbated by political challenges. This has led to surging debt levels, fueling an environment of extremely low, often negative, real interest rates. For example, short-term rates and even real bond yields are deeply negative, meaning savers in bonds face losses of 3 to 5% in purchasing power per year. This discourages saving and encourages borrowing, pushing money into other assets like stocks, goods, and services. As a result, while equities may seem a bit more expensive than average, they remain relatively attractive compared to overpriced bonds or cash. However, expected returns are broadly low, and we are in an inflationary period. Understanding this paradigm, how overspending, debt, and money creation interact with prices, is essential. The market's big question is how these forces will shift. Will the Federal Reserve and other central banks tighten monetary policy? What changes in tax policies or political decisions will emerge? These factors will determine future price movements. Historically, there's always a cycle between debtors and creditors. At times, like in the late 1970s under Fed Chair Paul Volcker, monetary tightening made saving attractive again. But those periods were typically preceded by excessive debt creation, like the 1960s spending on the Vietnam War, which forced the U.S. off the gold standard in 1971, leading to a decade of inflation. This cyclical pattern repeats. Sometimes high real interest rates reward savers. Other times, low rates favor asset holders as governments and central banks create money and debt. Recognizing where we are in this cycle helps investors anticipate returns. Mechanically, markets function as investors, borrowers, and lenders compare the expected returns on cash, bonds, and other assets. Shifts in monetary policy like raising short-term rates flatten the yield curve, slow lending, and cool the economy. This is how monetary tightening historically triggers downturns. The market, in many ways, resembles a poker game. It's a zero-sum environment where the well-informed often benefit at the expense of the less informed. America's role as the issuer of the world's reserve currency provides both advantages and risks. Being able to print dollars gives the U.S. immense buying power as others worldwide accept its debt. But if this debt accumulation becomes unsustainable, obligations to repay can cause severe future problems. Debt provides short-term stimulus but long-term drag. It's a cycle seen repeatedly in history. Inflation emerges from 2 main sources. Cyclical inflation, when demand exceeds supply capacity, pushing prices up. The central bank's willingness to accommodate determines how far this goes. Monetary inflation, when excessive debt creation and money printing devalue currency, making everything else appear more expensive. Currently, both types of inflation are at play. Strong demand fueled by massive money and credit creation, plus structural deficits unlikely to resolve soon. Looking forward, political factors like the cost of combating climate change will add structural pressures on inflation. Transitioning to greener energy, while positive in the long run, is expensive and reduces economic efficiency, contributing further to inflationary trends. This inflation is unlikely to be merely transitory. Combating cyclical inflation alone through monetary tightening could severely damage markets and the economy likely more than the Federal Reserve would tolerate. Meanwhile, structural deficits and growing obligations will still require money creation, embedding inflation into the system. Past debt crises offer critical lessons. When debt grows unsustainably and interest rates approach zero, central banks lose traditional tools to fix problems. This happened in the US in 1928 to 1931, again in 2007-2009, and each time the response was massive money printing to buy assets, inflating their prices and widening the wealth gap, a dynamic that often fuels populism and social unrest. Today, we are late in both the long-term debt and business cycles, likely in the seventh inning. A downturn is inevitable, perhaps in a few years. But central banks' ability to counter it will be limited by near-zero rates and exhausted quantitative easing. Meanwhile, political and social fractures, worsened by wealth gaps, will likely intensify future crises. In the next downturn, the challenge won't just be debt. Unfunded obligations like pensions and healthcare will compound the problem, possibly shifting the crisis from a debt crisis to a dollar crisis, with risks of substantial currency depreciation if the U.S. cannot sell enough treasury bonds without inflating rates. Investors should carefully study these cycles to prepare. Most shouldn't try to actively time markets, it's difficult even for professionals. Instead, balance portfolios. Understand how the bond market, the backbone of asset pricing, behaves, and watch for imbalances that could force central banks to choose between letting rates rise or printing more money, both with significant implications for inflation and market stability.